Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, joined by Brian London. Thanks for tuning in. If you have not already, please subscribe on YouTube, BitChute, SoundCloud, wherever you may be listening. Please give us a like also and comment. We have a great guest today, Keith Weiner of Monetary Metals. That is a precious metals fund. He is chief executive. The website is monetary-metals.com. He is Keith Weiner 01 on Twitter, and he has keithweinereconomics.com as his blog. Keith, welcome to the show.
Thanks, Fergus.
Great. And you have just written an article which caught my eye regarding, well, it's a response to Gregory Mankiw's article in the New York Times, The Puzzle of Low Interest Rates. Gregory Mankiw is probably the most prominent textbook writer in economics, at least of my generation. And you have both agreed and disagreed with him. And the puzzle, do you want to explain to people what is the puzzle? You know, when we say we have low interest rates, why is this so confusing?
Well, everyone thinks that there is supposed to be a normal interest rate, and that interest rate is supposed to respond to consumer prices or other signals in the economy. But if you look at a graph since 1981, the interest rate has been falling. So not just too low today, but also a falling trend. And in the mainstream theory, quantity theory of money, they don't really have a satisfactory explanation for how this could be.
One of the important elements here that both you and Gregory Mankiw bring up is that many people assume that the central bank is just dictating what the interest rate is. But both you and Mankiw say that really the central bank is receiving or trying to best decipher what the interest rate should be to keep some sort of equilibrium. Do you want to clarify the difference between initiating and interpreting?
I mean, certainly the central bank, the Federal Reserve, has enormous amounts of power and influence. So it's a feedback system where the Fed certainly has a great powerful input, but at the same time, the market is bigger than the Fed. And if the Fed just were to decide tomorrow, we're going to set the overnight interest rate, the Fed funds rate, at 10%, essentially there's a lot of different mechanisms by which that wouldn't work. They would not be able to do that, and they could cause a lot of harm, by trying to do that. And so they're trying to figure out, it's a put your finger in the air and figure out which way are things going, and then being responsive to that. While at the same time, they're looking at things like the zero bound, and others, and trying to figure out where this all goes, and so that as they try to manage it.
Yeah, and just like Mankiw does, that over the past 4 decades, there's been this just clear decline. And Mankiw noted, for example, that the 10-year Treasury note in 1981 was 15%, which seems out of this world at this point, and that the federal funds rate was 16%. There was even an 18% rate on 30-year mortgages. So a heck of a lot has changed during that time. And he runs through a bunch of different theories as to why it is that we live in this low interest world. And some of them are maybe good, some of them are not so good. Do you want to clarify why you believe the interest rate has fallen just so much over the last 40 years?
Yeah, so let me try to give while standing on one foot, 30-second version of my theory of interest. So they create a central bank, and the purpose, forget all the inflation expectation stuff and even employment. They create a central bank for one purpose, which is to enable the government and its cronies to borrow and spend more than they otherwise could if they had to, live on their tax revenues. So they want to push interest rates down, which makes borrowing cheaper. Unfortunately, they set something in motion. They set this dynamic in motion because there is such a thing as time preference. The saver has an idea of, well, if I don't get paid at least X, then why should I even bother to play? I'll just take my gold home and let them have their little system. And of course, in the gold standard, if you withdraw your gold coin, it forces the banks to sell bonds, which pushes bond prices down, which pushes interest rates up. And so what they get, and you see this shortly after the creation of the Fed in 1913, is a bit of a rising interest rate trend. So it's counter to what the Fed wanted. It's counterintuitive. The Fed's trying to push down, and you get things drifting up for a while. And that's a ratchet effect, because with each rise in interest rates, people are taking behaviors such as hoarding commodities, and ultimately corporations are borrowing. That is, they're selling more bonds in order to buy more, buffer up, bigger inventory levels at all their warehouses. And so you get this ratchet of more borrowing to fuel more buying of commodities, rising commodity prices, rising interest rates. But eventually, you get to the point where the interest rate is now above marginal productivity. You cannot borrow at 10% to make an 8% return on invested capital. It doesn't work. And so when that happens, you have a big bust, and a lot of firms fail. And then you get liquidations of commodities, and then the trend reverses, and you get falling interest rates, cheaper commodity prices. And that's what happened from about early 1920s through the end of World War II. And then starting in 1947, you had a rising cycle, which is much, much larger. We get to the absurd levels that you just quoted, and then subsequent to that. So when the interest rate is falling, you get the interest rate is above time preference, which was the problem why you had a rising rate when interest is below time preference. But it's also above productivity. And so, if you look today, as low as the interest rate is, the marginal firm is not able to borrow and make money at that rate. And so you get really weak demand for borrowing until the interest rate ticks down one notch further, and then you get a bit of borrowing. And so it keeps falling, because what we're doing is we're killing the productivity of capital.
Keith, Brian here. You make some interesting comments about the power in your letter. You make some comments about the power of the Fed, but also some. I think you also make some comments about the lack of power of the Fed. For example, you note that the bond vigilante is a myth, like the dragon and the unicorn, and that the consumer of interest rates, or the saver, has no way to opt out of the system when under irredeemable currency, and therefore all the power is with the Fed. Yet, if we look at what's going on now, in that the markets, this big house of cards that the Fed has created with all this progressively easier money over the decades, for it to go on, it demands to be fed not only easy money policies, but ever easier money policies, so that the long-term trend continues to fall. And the Fed has to go to give the markets what it wants. It has to continually lower rates. But at some point, it seems like there's an inflection point, and a lot of people point to this, that there has to be a monetary reset at some point, when the markets tell the Fed, this currency at this point has lost all credibility, and they start ratcheting rates, and the Fed then loses control. Do you think that's actually possible, or can you kind of explain that in the context of your theory?
No, because when rates rise, and you make a good point that the Treasury themselves can't afford to pay higher rates. I mean, the whole government's budget is bust if you set a rate of 5% or something like that. But the government's not the marginal borrower. The marginal borrower is the one who's going to default first. So that's going to be all the farmers, all the factories, all the student loans. I mean, everybody else is going to default first. So if you had rising rates, then that will just wipe out everything and everybody, which will be a reset. But it's like setting off a nuclear bomb. What I think, and to address your question about is there a loss of confidence in the dollar? Yes, absolutely, that's coming. And what that looks like, I call it permanent gold backwardation, when gold stops bidding on the dollar, or in dollar terms, gold goes no offer. That is, you want to trade your dollars for gold. Gold is the only way to opt out. If you hold dollars, you are financing, you are extending credit to the Fed, and the Fed extends credit to the government and the banking system. And even if you hoard paper dollars under your mattress, you're still a participant. You're disenfranchised in that sense. But if you buy gold, you opt out. Unfortunately, the person who used to own the gold, who sold it to you, is now opting in. And when the dollar truly loses credibility, nobody who owns gold is going to want to opt into the dollar anymore. And so that will lead to, people will call it hyperinflation, but it will have nothing to do with quantity of dollars. It will be just a repudiation of the dollar as anything that anybody chooses to hold. And that's coming, but I think that's, years away. It's not, I don't think that's imminent. And then that'll be obviously enormously destructive. That'll be a cataclysm, I think, akin to 476 AD.
Yeah, I would agree. I think it goes, we have these cycles where we have any kind of an economic hiccup or recession or whatever, and the Fed comes in and lowers rates down again. The last two situations, it enacted quantitative easing, and it breaks in each succeeding instance. It breaks all the records it set before, and even sets new sporting events to break records. And it comes up with new ideas and programs, and it's become very innovative. You have to give it credit in that respect, but it just ratchets up again its efforts. So I don't know whether it's, this cycle that the dollar loses credibility. I tend to think not. Things can continue much longer than you believe, but maybe 2, maybe 3 cycles down the road. But do you think that as that develops, before the dollar loses any credibility, all credibility, that the bond vigilantes will return at some point and start demanding higher and higher rates because of their loss of confidence in the currency, and that kind of reverses that trend?
Well, any kind of demand like that always sort of implies, okay, do this or else I will do that. And the problem is, in 1933, when FDR outlawed gold, he deprived, there is no or else. Right, so if you don't like the treasury bond, you can sell the treasury bond, and now you hold paper cash, or if you're a bigger player. I mean, I always put it this way: if you have $100, you can put it in your pocket. If you have $100,000, you can put it in a bank, and if you have $100 million, you put it in the treasury market. So you could sell your treasuries, and then you have a bank deposit, but the bank deposit still finances the treasury market. That's what banks do with deposits: is they invest in treasuries, and that's business model as well as regulation. The bank supervisors are there telling them how many treasury bonds to buy. There isn't any way to opt out. Now you can buy gold, but of course then the person who sold you the gold is opting in, and so the dollar is a closed loop system. There isn't any way for people to really express that preference, and so you get the gyrations. There's a bunch of selling, but then the next party steps up and buys, and we just saw that yesterday with a really strong treasury auction, and so I think the interest rate, continues to head back down. One point I want to make: why is there such confidence in the dollar? And I don't think it's faith, and I don't think it's just some illusion that somebody in the gold space just has to write the right magic words, and that will dispel the illusion, and everybody will get woke, as it were. It's everybody who owes money, which is virtually every productive enterprise on the planet. And around the rest of the world, in many cases, they owe dollars. In the US, very few businesses would borrow in a foreign currency, but in the rest of the world, most of the major ones have at least some dollar-denominated debt. All of those borrowers are obliged to produce as much as they possibly can and to sell it on the bid price in order to raise the cash in order to service their debt. If you're a farmer and you owe $1 million, you must grow and produce a lot of wheat and sell that wheat. And only by doing so do you keep the repo man foreclosure at bay. And as long as everybody owes dollars, and of course they're sinking deeper into debt, because with every drop in interest is a fresh new incentive If you didn't want to borrow at 5%, hey, sir, how about 4%? And if you still say no at 4%, we will now lend you at 3%, at 2%. So as the interest rate's falling, there's more and more incentive to load up on more and more debt. But once you're on the debt treadmill, now you find you have to service it. And so every producer of everything is frantically producing everything they can. And that's why in a falling interest rate trend, you tend to see soft, if not actually falling prices, you tend to see soft prices, which has been the case since 1981.
Well, you kind of anticipated my next question. If you're looking at the dollar as a closed loop system, and that people who participate and opt in are trapped within it no matter what they do. And large corporations, of course, can borrow in foreign currency. So how does this theory apply? Is it that all fiat currencies are closed loop, and that maybe the dollar strength or is not so much dollar strength, but its relative strength compared to the other currencies? It's the best looking house on a bad block, or it's the best looking leper in the colony, kind of a thing.
That's a new one. I haven't heard that one before.
I found that one many years ago. I forget who originally said it, but it's not so politically correct as all the other ones. But anyway,
right.
How does that then extend on a global basis? Because again, I guess an individual company can partially opt out of the dollar system by borrowing in foreign currencies, but then somebody's buying their dollars to sell them those currencies as well. So it's all one interconnected system.
Right. So the dollar itself is the closed loop. An individual person might, opt out of it. I would say it's buying gold, but they could also buy foreign currency. So what can happen is the price of the dollar, as measured in gold or as measured in euros, can fluctuate. But within the dollar, the interest rate is entirely set within a closed loop system. And so the mechanism for setting the interest rate isn't what people would assume. But yeah, you could sell your dollar off and buy euros you want, or conversely, you can keep your dollars and borrow euros. So effectively, you're betting the euro is going to go down if you do that, or you're doing it to hedge. If you produce in North Carolina and you export and sell to Europe, you may want some of your debt to be in euros to be a better match of income to liability. But the other thing that I think is worth saying or needs to be said, all the other currencies are dollar derivatives, right? Not only does every central bank in the world hold a very significant dollar position, but the major corporations in all the other countries, if there are a few American corporations that maybe borrow some euros, every major corporation around the world is borrowing dollars and holding dollars as well. So the dollar is on every major balance sheet in the world, and including the central banks. So, if you're the central bank of some other country, you hold dollars, and that's your reserve asset against which you create credit in your local currency. So all the other currencies are pyramiding credit on top of dollar credit. And so they're all dollar derivatives. None of them could survive, even if they even lasted that long for other reasons, none of them could survive the collapse of the dollar anyways. So the dollar is going to collapse, but it's not going to be replaced by euro or even yuan or anything else. There's only one 4-letter word that can survive the collapse of the dollar, and that's the one that, the mainstream and Greg Mankiw, and I wrote an open letter to the Economist, and nobody wants to acknowledge what's the one thing that will survive the collapse of the dollar.
Well, if you can opt out of the dollar system with gold, and it is the only way to opt out, aren't you forced then to opt in whenever you want to make a transaction? And I know you're actually actively working to reinstate gold as at least an investable currency with interest. But until and unless you can actually go buy a loaf of bread with gold, fractional gold, or silver, aren't you forced to opt back into the currency at some point?
Yeah, although I guess strictly speaking, when I say opt in or opt out, I'm talking about what you choose to hold your capital in. So you could certainly choose to hold your capital in gold, and obviously transactions in dollars. And then, of course, that segues to, the government has a lot of different ways of applying force to support the dollar and to discourage gold. So you have capital gains tax on gold. So if you sell a little bit of gold to buy groceries, you would now have to keep a ledger of every bit of gold you have, what date you bought it, what price you paid, and then, the day you sell it, and you now have to file a form to say, okay, well, I bought this back in 1978 and the price was $400 an ounce, and now I'm selling it. And so it's a very onerous reporting requirement. And depending on the capital gains, that could be, a strong disincentive to do that. And then if you're owning your gold through any kind of financial intermediary, the financial intermediaries are under regulations to encourage their clients to make reasonable and prudent, whatever that means, investment decisions. No financial advisor alive, no bank, around is gonna, is to say, yeah, you should keep 100% of your wealth in gold, because if the gold price drops, he's exposed to not only litigation by unhappy clients, but obviously FINRA and the SEC can take action, independently of that. And so, you're forced to participate in the dollar system in all these ways, some of them subtle and some of them not so subtle. And trying to be 100% in gold really is not practical today. And you're right, my company is working on a number of ideas to try to make it practical, but that's a long-term process.
So basically, you've addressed why the US has such low interest rates and why the US dollar has such inertia as a reserve currency, or the de facto reserve currency of the world. But you say that these things, have to come to an end at some point. Will we see inflationary pressure first? Will that be the catalyst for changes to that status quo?
In my view, and I part company a little bit from other Austrian economists in saying this. It isn't necessarily going to be rising consumer prices that really is sort of the end of the end. What I see is everything in our system today is a process of capital consumption and capital destruction. That every time the interest rate falls, asset prices rise. I've written articles about Bitcoin, doing this where somebody buys for 1,000, sells it for 2,000, the next guy buying at 2,000, expecting to sell for 4. I've written articles about people flipping houses, in the same house that was worth, $20,000 in 1968 is now worth $2 million. And every time the price of an asset goes up and it changes hands, somebody is forking over ever greater amounts of capital. And the recipient of that is receiving that capital, someone else's wealth, as his income. So nobody wants to be the prodigal son. Nobody wants to consume their own capital. But if they get someone else's capital that comes to them in the form of income, they're happy to spend it and consume it. And so if you look at it at things as this process of capital consumption, then of course it's clear what the end has to be. That is, when you run out of capital that's consumable, then you have a very great problem, a very great crisis, and everything blows up. And at the end, sure, consumer prices will be skyrocketing. There will be shortages because the capital required to produce food and energy is being depleted. It's being consumed. If you look at, for instance, and I wrote an article some years ago about oil refineries and how they're rusting and decaying and not getting the upgrades and maintenance that they should. And what happens when, and there was one that closed. I guess I wrote this article 5 or 6 years ago. There was a major one that closed. They just didn't have a business case to borrow more money and invest in it. And one by one, if you see them closing, then, if you can't deliver food and energy, that is going to be a human tragedy and catastrophe, the likes of which, the world hasn't seen since 476 AD.
I don't know that. To be frank, I just do not know that I understand that, and whether you can give a time frame. So, do you want to confirm though that you have no anticipation of any kind of increase to interest rates in the United States in the near future, and that it may be decades before any kind of end to the US dollar's hegemony?
I don't think it's necessarily decades. I think everything is accelerating faster and faster, but I don't see it as imminent. Certainly not tomorrow morning. I don't think it's within the next 3 years, let's say. So let's bracket it somewhere between 4 or 5 years, at the earliest, and 10, 20 years at the outside, somewhere there. At the moment, I see the trend of falling interest rates continuing, and of course with jitter, right? So if you look at the fall from 1981 to present, there's been some pretty, impressive looking rises. And at the time, everybody thought, oh, that's it. It's reverting to normal. And they're all head fakes. They're all unsustainable rises. The best example I can give is, and now this is almost moot, the story, but was it 2015, the Fed begins to hike the Fed funds rate. And so before that, all the major car companies were advertising 0% interest for 72 months. And at least one of them was advertising 0% for 84 months, which is just, this is all crazy, right? The rate begins to rise. And so even when the Fed funds rate was 25 basis points, for a car company to let you borrow from them at 0%, it's a subsidy. It's costing them something because they don't borrow at the Fed funds rate. And then on top of that, they have administrative costs and a certain percentage of people default. So their cost, even when the interest rate is effectively zero, I'm sure Ford's cost must be 2 or 3%. The rate begins to rise, and it rose pretty significantly during the Janet Yellen, rate hiking program. So the cost of that subsidy must have skyrocketed. I mean, I wrote an article saying I'm sure this took easily $1 billion off of Ford's bottom line, and they're making less than $5 billion. So that was a huge cost to them. But they must have done the analysis. I mean, you assume that they're not stupid. They must have done the analysis and figured out that, okay, they know exactly what that's going to cost them if they continue the program. But what would it cost them if they were to hike the rates commensurately and say, okay, now we'll give you 3% for 72 months? And how much, would the volume of cars sold, fall off a cliff if they did that? And I use that not just as an example of thinking at an auto company, but the demand for credit is soft. It's really weak. And there's only demand, demand only rises on a downtick. And that's a classic, market of falling prices. You can't sell anything unless you find the bid and hit the bid. And what happens when everyone's hitting the bid is the price is falling. And so the bid on the interest rate is falling. And it's at the point where consumers don't take credit unless it's at 0%. And it gives you an idea of just how weak demand really is. And, I'm just old enough to remember, I was 12 years old in 1979, just old enough to remember what things looked like. Now, I wasn't following interest rates as a kid, but I went to the grocery store with my parents every week. Every price of every product in the supermarket was up enough that it was noticeable to me as a kid. What did that bottle of Coke cost? What did that, bag of potato chips cost? Every price of every item every week. And that is not the environment that we're in today. And so I just see, consumer prices remaining to be soft, and I see interest rates, continuing to go down. And Europe and Switzerland and Japan have proven, and the UK have proven that interest rates can go negative, which is the most absurd thing. Nobody predicted that. And I wrote all these things up until 2015. I wrote as much as anybody about falling interest rates. And I said, like, falling into the black hole of zero. Even I didn't call, and even Mises didn't call, and nobody called what happens when they go below zero. And that's, I guess further proof that the saver is disenfranchised. Otherwise, how could you possibly have a below zero interest rate, which they do in Switzerland and Germany and some Scandinavian countries, the UK, Japan. And it's just a creeping rot.
Keith, some interesting points there. And, you talk about jitters along the downtrend line for interest rates, and we're kind of going through one right now as we speak. The 10-year yield, for example, just spiked, and it led to a big sell-off in gold because inflation expectations, while rising, couldn't keep up with that spike in interest rates as this new Democratic Washington, the reality of that and reality of the fiscal spending, tsunami on the way, et cetera, kind of hits the markets that rates really spiked up against set off a fall in the gold price, a big sell-off. The real thing that seems to be the big correlation for gold, the factor that seems to be the big correlation are real rates, rates adjusted for inflation. Do you think, or how does this fit into your theory of the long-term decline, downtrend in interest rates? Is it possible that we could have rates actually rise, but not outpace the rate of inflation and get to the point where we may have, like we did have in the 1970s, negative real rates of around 4% or so? Would that fit into your theory?
So, a couple of points. One, I try to look at what are all the forces that push prices up and down. And I think monetary forces are pushing prices down, not up. But there's a major source of pushing prices upwards, and that's what I call useless ingredients. When a regulator comes along, and I thought of that term because, gasoline in the summer, they have to put ethanol and other MBTE, methyl butyl tetraethylene, or whatever that stands for. And these things are expensive, but they're useless ingredients, right? If you just want to fuel your car, you just want gasoline, So the regulators constantly add more and more and more new useless ingredients. And so, if you're selling gasoline is sold on 5% or less margins, and suddenly they add 30 cents a gallon of cost, that has to go straight to the consumer. I mean, otherwise there's no way you could stay in business. If people look at inflation as just simply the rise in prices, they would include that in inflation, but it isn't monetary. And if anything, it's actually having the same effect as falling prices, in that it's falling margins to producers. And so I would say, look at margins, per unit margins for everybody from retailers to distributors to manufacturers. Margins continue to fall, and margins is what supports their bid on the interest rate. So as margins fall, their ability to afford credit is falling as well. Whereas again, going back to the 1970s, margins are rising. If you you bought some raw materials, from whatever, let's say Latin America, you put that on the slowest boat you possibly could to bring it to your factory in North Carolina. Why? Because by the time it got there, the value's already gone up. And then, you spend a lot of time really slowly manufacturing whatever it is you produce. Your goal is to get to market, 6 months plus after buying the materials. And so margins are constantly widening. So it's a great environment to be a producer, at least until your equipment had to be replaced. And then you try to go borrow more money and you find out that it's a new interest rate. You can't make any money anymore, and you shut down your factory, which is what happened during that era. But today, margins are compressing. Companies are on this treadmill, and it's cranking faster and faster and faster. The other thing is, I understand the argument that the dollar is being debased, and therefore you have to find some way of figuring out, if you're getting paid 2% interest. I was about to say 2% interest on a treasury bond, but that's not possible anymore. You're getting paid 1.1% interest on a treasury bond. What does that really mean? Because they're debasing the dollar. I totally agree with that, but I do have to sardonically observe that the actual rate at which actual lenders actually lend to actual borrowers is dismissed as nominal. And then separately, we take some inflation number, which nobody really agrees on what consumer goods go into the basket and how to measure it. But we take this contentious number that economists don't agree on, we subtract that from the nominal rate, and then we get something we call the real rate. So I just have to sardonically observe that real rate isn't as scientific as it would seem. And I would suggest, if you want to measure the basement of the dollar, look at the price of the dollar in gold. So invert it. Instead of saying, well, gold is 1900, say that the dollar is 16 milligrams, roughly. And then if the dollar goes to 15 milligrams, you say, okay, well, that was a loss of, what is that, approximately 6.67%, call it. And then if you're trying to get an interest rate to compensate you for that loss, then you find you can't. There is no, unless you want to take the risk of buying, Greek government bonds or something, there is nothing in the dollar world that's going to pay you the interest rate to compensate you for the loss as the dollar's falling against gold. So in a way, it's, I guess, even more bleak than it seems.
Yeah, and when you have Greek bonds trading at negative rates, then you you really have an interesting situation. And as they say, may you live in interesting times. We certainly are, aren't we?
Yeah, these are very interesting times. I've often observed if I was just had ambitions to be an academic, and if this topic of how our money is failing weren't critically important, it'd be a fascinating place to have a career and generate all these papers and have a lot of fun. But it's so critically important because it's destroying our world. And I rather like living in the world as it is now. And I rather dislike the idea of living in a post-collapse sort of world. The one thing that everybody should just be aware of, if you're living in a dark ages kind of world, or even let's call it 18th century, that's a young man's world. Most people are obliged to do, farm labor to make a subsistence living. When you hit 45 or 50 years old, you're at, past the end of your shelf life. It's not the sort of world that, you'd want to go into.
So out of us three, Fergus is the only one that's going to thrive in that world, I guess.
Even I'm over the hill in that regard, I fear. So, yeah, you can follow Keith Weiner at Keith Weiner 01 on Twitter, and he blogs both on his own website, keithweinereconomics.com, and on Monetary Metals, which is monetary-metals.com. Is there any other place we should go to follow you, Keith? Do you want to give a plug for another outlet?
I'm on Facebook. I think was it Keith.Weiner5 on Facebook? I don't remember my exact, but anyway, if you search for me, I'm sure I come up.
Sure. We'll include all his details at goldnewsletter.com/podcast. And as you can tell, Keith has plenty to say. He's got a lot of commentary, and I appreciate the work he is doing to innovate. If you look at Monetary Metals, to offer ways to use precious metals in an investment capacity. So I'm sure we'll have more on that in coming episodes. But Keith, thanks for your time. We look forward to being in touch.
Thank you.